Hey everybody, welcome back to accountingshit.com. So today we're going to be looking at accounts receivable and selling. And let's get into it because we need to make this business some money. Alright, selling services and accounts receivable. Now remember we've talked a little bit about accounts payable where people or businesses are billing you and you owe them money. Well, now it's going to be the other way around. So let's start making some money here. So selling services on cash. So you always don't have to use accounts receivable. There's no rule that says you have to. You can accept cash for jobs you do. So let's say you did a job worth $36,000. So that's going to go in your revenue account. And your revenue account is a credit account. It's going to sit there until you put it into cash, which is an asset. So receive cash is going to be $36,000. You did a job, a consulting job, whatever you did. As you can see up here, we still have all of our original assets and our accounts payable and our capital, but we're adding a new revenue to it. So $36,000 in cash, congratulations. Alright, so selling on credit. This is where accounts receivable comes in. And you always want to sell on credit because it is an opportunity for your business to make more money. Some people don't like selling on credit. I'm sure some small businesses only take cash. They don't do accounts receivable. They don't bill. They don't invoice. But a lot of contractor type service businesses will use this system. So let's take a look at an example. So you sold $11,000 worth of service, and that person said, "Hey, okay, great. I'll assign to the $11,000 and bill me every month or every quarter." So you put that under your accounts receivable. It is revenue. It came in. But now it's sitting in accounts receivable, which is an asset account. And it is just waiting to be collected on. So 30 days, 45, whatever the terms you gave, and we're going to go over terms later, they're going to owe you every month or they're going to pay you off once 30 days comes. But you don't have the cash in your hand yet. You do not physically have the money. But that is an asset account. Just do remember that. Alright, so that's where we come to collecting on accounts receivable. This is called collections, or if you've ever been called by a collections company, that's what this is. It's just accounts receivable. They're trying to collect the money on the account. Now remember I said you don't have the money in your hand. And you don't. You don't have physical cash in your hand. You have an IOU, which is still an asset. Alright, so here's the example. So, the firm that is going to owe you money gave you $6,000 out of the 11. So you receive that in cash, and you record that as $6,000. Now it's not revenue because it's already been recorded as revenue. It's already come in. It's just they physically gave you the money now, and now you can put that in cash, and now you come out with $125. And remember, your accounts always have to even out. Debits equal credits. Remember that. So we still have accounts payable. You still owe $3,500. You still have your capital. Your revenue right now is $4,700 that you've made into the business. Your accounts receivable is 11, and they paid 6, so they owe 5 still to you. And now we're going to go over net terms. Now this is, and I have an example of an accounts receivable invoice that we're going to send out to somebody. But net terms is how long you give the person to pay. So you have from 20 to 30 to 45, 60 and 90. This is the usual cycle. In between here, 30, 45, 60 is the usual typical cycle you'll get. Some is only going to give you 10 days. Some will give you 20 days. I have not seen that in the field yet. And I've worked, accounting for 11, 12 years now. Usually it's 30, 45 or 60. Rare cases it's 90, unless you need some kind of an extension. Due upon receipt means once you get that bill, you are required to pay it, or it is past due. I also have one down here that looks a little weird. 2%, 10 days, net 30, or 60. What that means is you can get 2% knocked off your bill if you pay within 10 days. If you don't pay within 10 days, then it's due in 30, or it can be net 60. Or it can be 90, whatever the net term is. So you have a chance to knock some money off. if you pay it early. Here's an example of a net terms on an invoice. I underlined it here, invoice term net 30. You'll usually see this, you got the item, the description, how much it is, and they'll put net 30. They'll put net 60, net 4, whatever the net terms are. And that's it for the slideshow. There's one more thing I wanted to show you. Let me see if I can pull it up here. Alright, so this is typically what an invoice looks like. This is just an Excel spreadsheet. But it's going to have the company name that's billing you, their address, their information, and then it's going to have bill to, so Bob's Automotive. It'll have the item and description, the price, item description, price, quantity. Down here would be the total, the tax rate if applicable, sales tax, and deposit received if you put money down. This is usually what it looks like in QuickBooks, and in my QuickBooks series you'll see a little bit more about that. But it'll have a make checks payable to company, thank you for your business, total due, and you got to put 30, 60, 90, whatever. But usually the net terms are going to tell you when they're on there. So that's all for this course in accounts receivable. Stay tuned. We're going to go over some more accounting. Thanks for watching.